Xpeng, ticker symbol XPEV, reported first quarter earnings results that disappointed investors. The stock price is down 9% following the announcement of these earnings. So in this video, I'm going to review those earnings results, and then I'm going to answer at the end of the video if this 9% stock price decrease is justified, or if this is an overreaction from stock market investors. Sometimes the stock market overreacts to news, and sometimes I feel they get it right. So let's begin. Let's review this quarter's earnings results. So revenue decreased by 46% to RMB 4 billion. The loss per share of RMB $2.71 was worse than the loss per share of 2 RMB last year. So the loss is getting worse, revenue is falling, and that was a result of total vehicle deliveries of 18,230 in Q1. That was down significantly from 34,561 in the same quarter the prior year. Xpeng is the dominant EV company in China, and that economy EV sales has fallen this quarter this year compared to the same quarter last year, as some government incentives to purchase EVs have faded away. So that has created a decrease in demand for EVs, as well as rising competition from newer companies like Tesla. So far in April, which was not included in the first quarter, deliveries were 7,079, only a slightly better pace than the first quarter, so it's not like things are improving very rapidly for Xpeng. The smaller total of vehicle sales brought its gross profit margin down on vehicles to negative 2.5% in the latest quarter. This was down from a positive 10.4% in the same quarter last year. On a good note, Xpeng's self-operating charging network reached 1,016 stations, including 816 supercharging stations. That could increase demand for folks to buy Xpeng cars, because one of the things that's holding people back from buying electric vehicles is the inconvenient charging method, right? Compared with filling up gas in your car, which can take a couple of minutes or less. Filling up your EV or charging your EV can take upwards of 30 minutes. So that's a huge difference and a huge inconvenience. And the more companies can broaden their charging network and speed up the charging of EVs, the more it'll entice consumers to purchase more EVs, which ultimately will be great for the environment. Xpeng expanded to 425 physical stores across 145 cities, so really expanding its sales network. And of course, the more sales stores you have, the more you're going to reach customers who can come in, look at your cars, talk to salespeople, and it'll boost consumer demand. Also, the company said the G6, the first production model built on its next-gen technology, will be launched in June 2023. The CEO said, "I believe the G6 will emerge as one of the most popular best-selling models in China's SUV market, with a price range between 200,000 and 300,000 RMB." So Xpeng has a new model coming out while consumer demand is decreasing, and other competitors also have new models coming out. So supply is increasing at a time when consumer demand is decreasing. All the more bad news for EV companies in China, right? The more competition, the more supply, the more you're going to have to lower prices to get the consumer to buy your car versus another car. And so to answer the question, is the 9% stock price decrease of XPEV justified? I say yes, it is justified. This is intended, the valuations on EV companies are growth dependent valuations, meaning that the stocks are valued as if there's going to be growth over the next 5 to 10 years in EV sales, which there should be, right? But the increasing supply increasing competition means that those rising EV sales are being spread among more competitors. And so while companies like Xpeng have a gross dependent valuation, their revenue are actually not growing as rapidly as was expected. So a decrease in the stock price, in my opinion, was justified. All right, that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.